SoFi is attempting to disrupt the banking industry, and the stock just surged to a new 52-week high. At the latest price, SoFi now has a market capitalization of $18 billion and a book value over $6 billion. Revenue over the last 12 months comes to $2.5 billion, with $214 million of net income and $650 million of adjusted EBITDA. So SoFi's stock is now valued at 2.9 times book value, 7 times revenue, and about 29 times EBITDA. SoFi's stock is surging because the company is putting up incredible growth numbers. Revenue has more than quadrupled since 2020 and was up another 30% in the latest quarter. New members and products continue to ramp at impressive rates, and while legacy banks like Wells Fargo have seen their customer deposits decline in recent years, SoFi has seen deposits expand by a remarkable $23 billion. These growth metrics are important because they signal that SoFi is taking market share and giving real value to customers. And SoFi's digital infrastructure allows it to keep costs low and generate real earnings. However, short interest on SoFi's stock sits at around 14% because some investors still don't trust SoFi's growth. They argue that rapid growth for a bank is a red flag. And that's a concern which is amplified by SoFi's growth-centric compensation plans. According to bears, rapid growth can only come from taking on higher-risk loans, and they note that SoFi's historical loan losses are running at much higher rates than other banks. If that's the case, SoFi's balance sheet could come under significant pressure during an economic downturn. In other words, SoFi can keep winning now, but only until the next credit event comes along. Bulls say that SoFi has simply found a better way to price loans, and the company's diversified business model means it should be valued more as a tech company than a bank. After all, it's already been able to navigate the volatility of the past few years, and the company's platform revenue is growing rapidly. But most of SoFi's revenue does come from the origination of loans, just like any other bank. So the distinction as to whether SoFi is a technology company or a bank is an important one. Valued as a tech company, SoFi looks reasonably valued at about 29 times adjusted earnings. But valued as a bank, the company looks expensive at 2.9 times book. For comparison, JP Morgan has a price to book value of 2.2 and Bank of America a book value of 1.3, and value investors typically like to buy banks when they trade below book value. Ultimately, whatever valuation method you use, SoFi stock doesn't look that cheap, and there's a risk that SoFi is prioritizing growth over stability. But these are my personal opinions, not financial advice, and I hold no position in SoFi. For more investing videos, make sure to visit my website at 3minutebreakdowns.com. Thank you for watching.